In the last few days, one of the cleanest real economy signals quietly turned up: the Baltic Dry Index. It is the price of moving raw materials by sea. In the week ending January 30th, the Baltic Exchange Weekly Report put the Baltic Dry Index at about 2,148. It was coming off a 6-month low from mid-January. That is the receipt. A single number that tells you shipping demand and shipping tightness are changing. This is education, not financial advice. Here is the promise. By the end, you will know what that rebound is really saying, what it is not saying, and the 3 signals that confirm it within days. This looks like a simple trade story, but it is actually a funding and growth story that starts with physical logistics. Let's make it concrete. Imagine a steel mill in South Korea buying iron ore. They book a Cape-size vessel from Australia. Their cost is not just the ore price. It is ore price plus freight plus time. When freight jumps, their delivered cost jumps. If they cannot pass it on, margins compress. If they can pass it on, prices creep into the real economy. That is why this index matters. The Baltic Dry Index is not container shipping. It is dry bulk. Think iron ore, coal, grains, and bauxite. So when it moves, it is usually pointing at industrial supply chains, not iPhone shipments. Here is the core mechanism. Freight rates rise when either demand for ships rises or supply of ships is constrained, or both. Demand rises when buyers move more ton miles. That can mean more cargo, or longer routes, or faster restocking. Supply tightens when vessels are tied up, delayed, or parked for maintenance. In plain terms, this is a tug of war between how much stuff needs moving and how many ships are actually available. Now, anchor it back to the receipt. The Baltic Exchange Weekly Summary, published February 2nd, flagged the rebound to 2,148. If the rebound is demand-led, it tends to show up first in Cape-size rates because iron ore is the largest flow. If it is supply-driven, you often see a different fingerprint, like congestion or weather delays. So, what happened in timeline terms? Mid-January, the index hit a 6-month low. By the end of January, it had climbed back. That is the move the market can trade around, but the story is what it implies for the next few weeks. Here is the first common misread. People say, freight is up, so growth is booming. Not necessarily. Freight can jump because ships are stuck, not because demand is hot. So, we have to ask a better question. Is this demand, or is it friction? Go back to our steel mill. If the freight move is congestion, the mill gets late deliveries. They pay more, and they wait longer. That hurts production schedules. It does not signal strong demand. It signals bottlenecks. If the freight move is demand, the mill is rushing cargo because orders are strong. They may accept higher freight to keep lines running. That is a different world. The second misread is the inflation leap. People hear higher freight and assume CPI spikes next month. Freight is one ingredient in landed costs. The pass-through is slow, and it depends on inventory levels and pricing power. Put simply, freight can be loud now, while consumer prices stay quiet for a while. Now, let's widen the lens. Why does a dry bulk index matter to markets that trade rates, FX, and credit? Start with rates. If freight is signaling stronger industrial activity, markets can price more growth. That can nudge yields up, especially at the front end if central banks stay cautious. If freight is signaling bottlenecks, markets can price a stagflation risk. That can also keep yields sticky, but for a worse reason. Now, FX. A true pickup in bulk flows can support commodity exporter currencies. Think Australia, Brazil, Chile, South Africa. A friction-driven spike can do the opposite because it raises costs without raising demand. That is when FX gets defensive. Now, credit. Shipping is a working capital business. Higher freight rates raise the cash tied up in transit. Importers borrow more to carry inventories. If bank lending is tight, or if funding costs rise, that stress can surface in credit spreads. In plain terms, higher freight can mean higher financing needs, even before sales rise. Back to our anchor example. Our steel mill does not just buy ore, they hedge currency, they hedge energy, they use short-term credit to bridge inventory cycles, so a freight move can hit them through 3 channels at once: cost, time, and financing. This is why this topic can support a full-length breakdown, because it sits at the intersection of physical flows and financial conditions. Here is a familiar stress sequence when freight is friction, not growth. First, freight rises. Then delivery times slip. Then inventories get rebuilt defensively. Then pricing gets weird because availability matters more than sticker prices. You can see the difference in related markets. If this is real demand, iron ore prices tend to firm, not just freight. Energy demand tends to firm too. And equity leadership shifts towards cyclicals. If this is friction, you often get freight up, with commodity prices flat or down. That is the mismatch. Price says one thing, availability says another. That mismatch is exactly what we want to hunt, because it is where stories go viral, not because it is dramatic, because it is testable. Here's the receipt moment language. Look at the Baltic Exchange weekly report number, 2,148 for the week ending January 30th. That is the line that moved. Now, ask what moved with it. If you only look at the index, you miss the why. Dry bulk is segmented. Capesize is iron ore and coal. Panamax is grains and coal. Supramax is smaller, more regional cargo. A broad rebound tells a different story than a single segment spike. In the next block, we are going to separate three drivers: cargo demand, route length, and ship availability. And we are going to keep checking on our steel mill, because the real question is simple. Is their delivered cost rising because demand is strong, or because the logistics system is strained? That answer changes what breaks first. In a demand story, the first break is inflation pressure. In a friction story, the first break is margins and delivery schedules. Let's separate the three drivers clearly. Driver 1 is cargo demand. How much dry bulk is being booked? Iron ore, coal, grains, and related inputs. Driver 2 is route length. Even if volumes are flat, longer routes increase ton miles. Ton miles are the real unit that eats ship capacity. If ships have to sail farther, the same number of ships moves less stuff per month. Driver 3 is ship availability. Ships can be unavailable even when they exist. Weather delays, port congestion, mechanical downtime, crew issues, or ships slowing down to save fuel. That last one matters more than people think. Here is the practical test. When demand is the driver, you usually see the bulk commodities themselves firm up. Iron ore and coal prices tend to stabilize or rise. When friction is the driver, you can see freight up while commodity prices do not confirm. That divergence is a key tell. Plain English. If the shipping cost rises but the stuff being shipped is not getting more expensive, the system is probably jammed, not booming. Now, how do we tie this to something viewers can track without becoming shipping analysts? We are going to use exactly 3 signals, and we are going to name where to look. Signal 1 is the Baltic Dry Index itself, but with a twist. Track the next 2 weekly prints, not one day. Where to look? Baltic Exchange, weekly summaries, and financial press recaps. What direction matters? 2 consecutive weekly rises confirm momentum. Typical lag. 1 to 2 weeks to confirm a regime change. Signal 2 is a simple commodity confirmation. Pick iron ore or thermal coal and watch whether the price follows the freight move. Where to look? Commodity price dashboards and daily market recaps. What direction matters? Commodity prices firming alongside freight suggests demand. Typical lag, a few days to 2 weeks. Signal 3 is the risk asset translation. You want something that responds to global growth expectations. A clean one is the relative performance of cyclicals versus defensives, or industrials versus staples. Where to look? Sector performance heat maps and index dashboards. What direction matters? Cyclicals, outperforming, supports the demand story. Typical lag, days to a couple of weeks. Those are your 3 signals: weekly freight, commodity confirmation, and equity leadership. Now, let's revisit the anchor example, our steel mill in South Korea. What changes over the next 24 to 72 hours? Not their sales, their quote sheet. If freight rises, their procurement team sees a higher delivered cost immediately. They either accept tighter margins, or raise prices, or delay orders. The fastest response is usually delay. That is the first pressure point. If freight keeps rising for a full week, the mill's treasury team starts caring. More cash is tied up in transit. They may draw more on credit lines. If bank lending standards are tight, that gets expensive. Now, what changes over the next 2 to 6 weeks? This is when the macro signal becomes visible. If demand is real, you see higher throughput, higher order books, and sustained commodity strength. If friction is the driver, you see uneven production schedules and weird inventory behavior. And if this persists for months, this is where a freight story can turn into a policy story. Persistent logistics tightness can keep goods inflation stickier than central banks expect, or it can crush margins and slow growth. Either way, it feeds back into rates, credit, and FX. That is the stakes ladder in real time. Now we need to answer the what breaks first question explicitly. If this is a friction story, the first thing that breaks is not the global economy, it is reliability. Delivery times become uncertain. Then margins get squeezed because over time and expediting costs pile up. If this is a demand story, the first thing that breaks is capacity. You hit a ceiling where the system cannot move more without higher prices. That is when freight can stay elevated and spill into broader inflation expectations. So, where is the tension, newsroom safe, no doom? It is here. Freight is rising and the index rebound is real. But the market still has to prove whether the rebound is demand or friction. Now, let's add the anomaly scanner. This is how you keep the story viral but factual. Anomaly to watch. Freight up while commodity prices are flat or falling. If that happens, it is a price says X, reality says Y moment. Prices are telling you demand is not strong, but logistics is tightening anyway. That is where companies get surprised. If the opposite happens, freight up and commodities up, that is a cleaner growth pulse. Then the spillovers are more straightforward. Now we need a clean receipt shot on screen. We show the Baltic Exchange weekly report line for the week ending January 30th with the index at 2,148. Then we show the mid-January low. Then we show the week-to-week rebound. That is a clean, honest visual proof. We also show one commodity chart next to it. Iron ore works. But keep it simple. We are not forecasting prices. We are identifying the direction of confirmation. Now, one more plain English translation before we land this. Freight is like a heartbeat monitor for the real economy. It does not diagnose the illness alone, but it tells you something changed. Next, we will close with a tight recap and repeat the 3 signals, and we will give you a practical checklist for the week. Let's recap the facts, then the meaning. The verified receipt is the Baltic Dry Index print. The weekly report shows the index around 2,148 for the week ending January 30th. It was rebounding from a 6-month low in mid-January. That tells you the cost of moving dry bulk cargo rose fast. Now the meaning. This move is not just a shipping story. It is a cost and timing story for industrial supply chains. And it can become a growth, inflation, and funding story depending on the driver. If the driver is demand, freight rises because more cargo is being booked. That usually brings commodity confirmation. Iron ore and coal stabilize or firm. Cyclicals start to lead. In that world, the risk is capacity. The system hits a ceiling and costs stay elevated. If the driver is friction, freight rises because ships are less available. Congestion, delays, slower sailing, or disruptions. In that world, the risk is reliability. Businesses pay more and wait longer without selling more. Margins take the hit first. Now, revisit our anchor example one last time. That steel mill booking ore. In the next 24 to 72 hours, their delivered cost changes first. They may delay bookings or accept tighter margins. In the next 2 to 6 weeks, the story either confirms as a demand pulse or reveals itself as a bottleneck problem. If it persists, it can feed goods inflation or squeeze corporate profits, which eventually shows up in policy expectations and credit. That is the stakes ladder. Now, the 3 signals exactly and where to look. Signal 1. The next 2 weekly Baltic dry prints. Where to look? Baltic Exchange weekly summaries and mainstream market recaps that cite the weekly number. What direction matters? 2 consecutive weekly rises confirm a real shift. Typical lag, 1 to 2 weeks. Signal 2. Commodity confirmation using iron ore or coal. Where to look? Commodity dashboards and daily recaps. What direction matters? Commodities firming with freight supports demand. Flat or falling commodities with rising freight supports, friction. Typical lag, days to 2 weeks. Signal 3. Equity leadership, cyclicals versus defensives. Where to look, sector heat maps, and weekly performance summaries. What direction matters? Cyclicals leading supports growth. Defensives leading while freight rises supports a cost shock. Typical lag, days to a couple of weeks. If you only track those three, you can read the story without guessing. And here is the pressure point, the what breaks first line. Watch for freight rising while commodity prices fail to confirm. That mismatch is where supply chains get surprised. One last newsroom safe reminder. Freight is noisy day to day. The weekly trend matters more than the intraday prints, and 1 week does not make a cycle. But the move to 2,148 is a real receipt, and it is early enough that you can actually watch the confirmation in real time. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.